Coco's OAF one-on-one, and my name is Mang'ana, CPAT, from the Faculty of Business Management, Department of Accounting and Finance. I'm an assistant lecturer with the Open University of Tanzania, and today I'm going to share with you a very small concept. We are also going to look at the classification of accounts. So basically, we are going to see what an account is, and then we are going to look at how we are going to classify, or how these accounts have been classified. Okay. Now, I'm going to give you this chart whereby you can see classification of accounts, and the reason as to why I decided to come up with this video is to explain to you these accounts and the accounting treatment for these accounts. Now, the accounts have been classified into two categories. The first category, we call it the personal accounts, and the other category we call them the impersonal accounts. So when you look at the personal accounts, as you can see in the slide here, the personal accounts here normally deals with the debtors accounts and the creditor accounts. And the impersonal accounts, it has been divided into real accounts and nominal accounts. Okay. Now let us start by looking at the personal accounts. Now we're saying, it's the name itself, personal, and as I've said before, that we are going to deal with the creditors and debtors. So accounts in the name of a person, these are the ones that are known as personal accounts. For example, when you have the debtors, of course you're going to have the names of those debtors. For example, if you are you're indebted to someone, then for example you're saying Baba account, or Sali account, or Kuru account, or Saganga account, being all these the debtors, then you're saying it falls under the personal account. But again, you might be having also the names, but falls under the creditors account. The same names, for example, Saganga account, or Francis account, or Dr. Shai's account. All these names, of course, as long as these are your creditors, and then they are falling under the personal account. So what I'm trying to tell you here, under this classification of a personal account, we normally mean all those accounts that are in the name of those persons, and basically we mean either the creditors or the debtors. Okay. And another classification here, we have the impersonal account. Now, what do we mean by impersonal account? Now, these are the accounts other than the personal accounts, but are those that have been classified either falls under the real account or falls under the nominal account. Okay. Now, the real account in which property is recorded, or when we call or asset have been recorded, assets also falls under, or property falls, or most of the property falls under assets category. But the nominal account, these are the accounts that normally falls or incorporate elements under the income expenses, or elements that falls under the income statements. The elements that you might find them under the income statement. So these also include the revenue and the expenses in itself, and sometimes even the capital that is recorded is also falls under the nominal accounts. Okay. Now, what is the real account? We know that the impersonal account, under impersonal account we have the real account and nominal account. Now, what do we mean by real account? Real account, these are the accounts of assets or property, and what do we mean by asset? We're saying assets are those items of value that are owned by a business, and then these assets may either be tangible asset or intangible asset. For example, you might be having goodwill being an intangible asset, but real accounts are impersonal accounts which are tangible and intangible in nature. So real account incorporate accounts that are impersonal accounts, but which might also be tangible and might also be intangible. Let us see some of the examples of the real accounts. One example of real account is the cash or cash account, a building account, and elements that falls under category of an asset. Okay, and we are saying real account relates to things that you can feel, you can see, and you can also touch. I repeat, real accounts relate to the things that you can feel, you can touch, and you can even see them. But also, you might be having an intangible assets, of which these are the things that you cannot even see them. Okay. And then when you talk of nominal accounts, these are the accounts that still also falls under the impersonal category, but these are the invisible and they are also intangible. So nominal accounts are related to those things which you can feel but you cannot see and you cannot touch. Now you can see the difference here. With the real accounts, you have elements that you can feel, you can touch, and you can see. But with the nominal accounts, you have those elements that you can only feel, but you cannot see and you cannot touch. For example, when you have a loss, of course you can feel that you are having a loss, but actually you cannot touch a loss. Or when you have an expense, yes, you can feel that this is an expense, but you cannot touch it, or you cannot even sometimes you cannot even see it. Okay. So elements like elements that falls under the income and revenue, or the income and expenses, they fall under the category of a nominal account. Okay. Examples of transactions or example of account that falls under the nominal accounts, we have the salary, we have the rent account, wages. You see, these are the expenses account. Now you can feel, but you cannot touch. For example, you cannot touch the rent expense. You cannot touch, but you can feel that, yeah, I'm going to pay. I'm paying for the monthly rent. You feel it. You feel the pinch of paying your rent. Okay. You can even feel when you're having your salary. You can feel it that this is a salary. Okay. Now let us see the accounting treatment of these accounts. Now what I'm going to end up today is giving you the rules for debiting and crediting these accounts. As I've said, we have now 3 accounts: the personal accounts and the impersonal accounts. With the personal accounts, here we have debtors and creditors, but with the impersonal accounts, we have real accounts and nominal accounts. Now let us start with the personal accounts. Here, this is the rule: you debit the receiver and you credit the giver. I repeat again, the rule under the personal accounts, and by saying personal accounts, I refer to the debtors and creditors. Then you're going to debit who is going to give you. In a simple way, you debit the giver, and then you credit it. You credit the giver and you debit the receiver. I repeat, you debit the receiver and you credit the giver. Under the real accounts, you're going to debit what comes in, and then you credit what goes out. I repeat, under the real accounts, you're going to debit what comes in and you credit what goes out. Under the nominal accounts, the rule is you're going to debit all the expenses and losses, and then you're going to credit all the income and gain. Now let us see some of the examples that is going to illustrate or illustrate what I'm trying to say. For example, I'll give an example under the real accounts. For example, let us say a transaction that involves a cash. Maybe you're going to pay someone, or if you're going to, let us assume that you're going to pay, or you're going to pay for a certain expense. Okay. Now, taking into consideration cash is a real account. So if cash is going out, then under the real account, we are saying you credit what goes out. Then the treatment here, we're going to credit the cash account. But if cash is coming in, then you're supposed to debit what comes in. So if someone is paying you, if a creditor, if the debtor is paying you back, then you're going to debit the cash account. I think it is understood. Okay. To make it more simple, you can see this slide that shows you the effect of transaction on a debit and credit side of an account. Now here with this column, you see I have 2 columns, the debit side and the credit side. Now look at the debit side. These are the elements that you're going to debit when you come across them. If you have an increase in an asset, then be sure you're going to debit. If you have an increase in an asset, debit that account. If you have a decrease in liability, again debit that account. If you have a decrease in equity, debit that account. If you have a decrease in expense and decrease in sales, you debit. So these are some of the transactions that, of course, falls under the debit side, or they have a debit nature. An increase in asset, decrease in liability, decrease in equity, increase in expense, and decrease in sales. Now let us see the other side, which is the credit side. Then when you have these elements, and then be sure that you are going to credit them. When you have a decrease of an asset, now you see that it is sort of a vice versa from the debit side to the credit side. Now when you have a decrease in asset, then you credit it. You have an increase in liability, an increase in equity, a decrease in expense, and an increase in sales. I'll repeat: an increase in sales, a decrease in expense, an increase in equity, an increase in liability, and a decrease of an asset. Now I hope now you have understood these basic principles or basic rules that affect the transaction of on a debit and credit side of an account. But again, the rules for debiting and crediting those accounts that we've been classifying them. But more important, we were looking at the classification of accounts, and simply we came to an understanding that accounts are being classified into personal accounts and impersonal accounts. At this point, I should thank you for being with me, and I hope you've enjoyed it, and I welcome you again